When it comes to investing in the U.S. stock market, you're going to hear two names over and over again, VOO and QQQ. They are absolute titans. But here's the thing. While they both give you a piece of the action, they do it in completely different ways, representing two totally different investment philosophies.
So, the big question we're really digging into today is this. What's your style? Are you looking for the slow and steady, broad stability that covers the whole market? Or are you chasing the high-octane speed of the tech world? The answer honestly has everything to do with your personality as an investor.
To really get a handle on this, let's think about these two ETFs like they're two different characters on a journey. In one corner, we have VOO, who we'll call the steady all-rounder. And in the other corner, we have QQQ, the tech-powered specialist. By following their two very different paths, we're going to see what really makes them tick.
All right, here's our game plan. First, we'll break down their core difference. Then, we're going to pop the hood and look inside their engines. After that, we'll get to the juicy stuff, performance and what it costs you. We'll also tackle the risk factor. And finally, we'll wrap it all up to help you see which path might just fit your own journey.
Okay, first things first, we have to talk about the most fundamental difference between these two. It all boils down to the indexes they're built to track. See, these ETFs aren't just a random basket of stocks. They are designed to perfectly mirror very specific parts of the market.
So VO tracks the one and only S&P 500. The best way to think about this is like a giant snapshot of the entire U.S. economy. You're getting the 500 biggest, most established companies in America. That means you get a piece of everything: tech, healthcare, banking, you name it. It's designed for maximum diversification.
And then there's QQQ. It plays a totally different game. It tracks the NASDAQ 100. This is a much more exclusive club. It's the 100 largest companies on the NASDAQ exchange, but, and this is key, it excludes financial companies. So what does that mean in the real world? It means you're making a big, concentrated bet on innovation and technology. Just to put a number on that diversification we talked about, VOO holds around 504 different stocks. I mean, that is a massive basket. You're really spreading your investment across a huge chunk of the market. And right away, you can see the contrast. QQQ holds just 101 companies. It's so much tighter, so much more focused. You're not buying the whole market here. You're buying a very specific tech-heavy slice of it.
Okay, so one has over 500 stocks, the other has just over 100. How does that actually shake out in practice? Let's go under the hood and see what's actually powering these two different engines.
When you look at VOO, the word that comes to mind is balance. Yeah, technology is the biggest slice of the pie at about 32%. But look at everything else. You've got big, healthy chunks of financial services, healthcare, consumer goods. This is exactly why we call it the all-arounder. It spreads its bets out.
Now compare that to this. This is the specialist, no doubt about it. More than 52% of QQQ is pure technology. That is a massive concentration. And the next biggest slices, communication and consumer cyclical, are also filled with tech-focused giants. This is the engine built for growth.
Now you might look at this and think, hey, they've got all the same big names at the top. And you'd be right. But the real story here, the crucial detail, is the weighting. Take a look at NVIDIA. In VO, it's a hefty 5.6%. But in QQQ, it's a massive 8.4%. QQQ takes those same tech giants and just cranks up the volume, which supercharges their impact on performance, for better and for worse.
All right, so we've seen what they're made of. Let's get to the bottom line. How have these two different strategies actually performed over the years, and what's the price of admission to own them?
Well, the numbers here kind of speak for themselves, don't they? Whether you look at the last 3, 5, or 10 years, QQQ's intense focus on tech has delivered some seriously higher returns. That almost 5% difference over a decade, that is a huge deal. But, as we're about to find out, that extra reward definitely comes with a catch.
And here is that price tag. VOO is ridiculously cheap to own with an expense ratio of just 0.03%. Let me put that in perspective. For every $10,000 you invest, you're paying just $3 a year. QQQ costs 0.20%, so that's $20 for the same investment. Now that's still pretty low, but it's more than 6 times as expensive. And trust me, that difference really adds up over time.
So QQQ has had better returns. But what about the other side of that coin? Risk. Because usually when you're reaching for higher rewards, you've got to be ready for a much bumpier ride. And that is exactly what we see here.
Okay, let's break this down. Volatility is basically a measure of how wild the price swings are, and you can see QQQ's ride is quite a bit wilder. But the number I really want you to focus on is max drawdown. That's the biggest, most painful drop from a peak to a bottom in the last 5 years. VOO fell almost 25%. That's tough, but QQQ, it plummeted over 35%. That's a much deeper hole to climb out of, and you have to have a seriously strong stomach to handle that.
So, after all that, looking at the engines, the performance, the cost, the risk, we come back to the main question: which path fits you? But before we wrap this up, just a very important reminder, this whole explainer is for your information only. It is absolutely not financial advice. The whole point is to give you the knowledge to make your own informed decisions.
At the end of the day, it's about asking yourself, which one of these sounds more like me? VOO, the steady all-rounder, is an incredible choice if you're building the core of your portfolio. It's for the person who wants low fees, stability, and that wide diversification across the whole U.S. economy. On the other hand, QQQ, the tech-powered specialist, is for the investor who's laser-focused on growth. It's for someone who truly believes in tech's future, has a long time to invest, and is totally comfortable with that extra volatility we talked about.
So there you have it, the steady all-rounder versus the tech-powered specialist. Two very different ETFs telling two very different stories, built for two different kinds of investors. The only question left is, now that you know the paths, which one aligns with your journey?